But it's interesting how, CEOs have to manage the short-term expectations, the staff incentives, and the long-term direction of the company, all through the impact of stocks.
Yeah, I mean, the other piece of that on the Facebook side was, do you remember their mobile app after they went public? It was awful. that was on its own. It was that bad, and they rewrote that, and it got great, and it was fast, and then all of a sudden, mobile revenue started pouring in, and then the stock jumped right back up. Which is the other thing. People get hung up on what's going on with the price of my stock? How much should I price the IPO versus where does it close that first day? Does it move around in the earnings? And really, the answer is great performance solves everything. If your company's performing at a really high rate, if you're generating a lot of free cash flow, if you are really hitting all your metrics, the stock's going to do fine. It'll jump around because we have a president that tweets weird things out every day, and that's going to change the market. But at the end of the day, if your company's performing well, your stock's
high frequency tweeting. Any other question? Yes, over there.
Sure. How do you think about VC investors versus public equity investors? They have a little bit different mindset and a different, I think, way of thinking how to value a company. So when you go from the private stage to the public stage, because basically you see a lot of companies, they kind of go either IPO still goes up and then drops and then takes years to recover, or it's immediate takeoff. So if you are a founder, how would you recommend to think about, preparing for what kind of takeoff it will have, or maybe there's something you can do to actually guarantee a better takeoff than the worst?
Yeah, I think as you're thinking about VCs versus public equity investors, I think the right way to think about it is with VCs, you're selling futures. You're saying, we're going to change the world. This is going to be huge. Here's the hockey stick. We're going to be enormous. With public equity investors, you have to be selling reality. Here's what we are going to do, guaranteed. Because the second you miss, that's when you see the stock do that, right? If you come out in your first 4 quarters, you do exactly what you said you were going to do. This is why public equity investors love SaaS companies, because they have 90% of their quarter baked in at the beginning of the quarter. They know exactly what the revenue is going to look like. They obviously want to look at bookings and billings and make sure the business is continuing to grow, but they want to see that nice, consistent model. And that's just, as a public equity investor, you are, by nature, much more short-term focused. I think when you kind of wipe out a lot of the high-frequency trading around kind of the margins, average hold period in the public market is probably around 3 months, right? Mm-hmm. Average hold period for VC is about 10 years. So that kind of drives it.
So it sounds like for when you're public, you really have to be really strong at forecasting, actually kind of doing much better than you expected reflects kind of poorly on your forecasting skills. Through saying what you're going to do, doing it, you build trust, and that's that's rewarded by public investors.
Unless you're Apple and you just always beat the estimates. Some magic weapon.
Maybe they estimate just a little bit lower, or it's the analyst doing the estimates, right?
So that's right. So it's consensus, and they kind of make a poll, and best minds put together still can't tell how well they're going to do. Okay, question then? Yeah.
What does it think the skill set of the startup entrepreneur aligns with a publicly traded CEO?
That's a great question. So, I think when you're a startup CEO, I kind of think about the fact that you have 3 jobs. You have to set the vision, you have to attract and retain the best people, and you have to keep money in the bank. Right? If you do those 3 things as a startup founder, you've got a clear vision, you can build a strong team, you can keep money in the bank, whether through revenue or funding, you're doing your 3 big jobs. Right? Once you go public, you have a 4th big job, and that is keeping Wall Street happy. Right? And so the question is, can you do all 4 jobs? Because by the way, the first 3 don't go away. You still have to set the vision, you still have to keep a strong team, you still have to keep money in the bank. But you just now all of a sudden have this 4th job that, frankly, some people are good at, right? And some people, struggle with. And it comes down to sometimes it's a certain level of sophistication, right? You need to be able to understand exactly why the analyst is asking that question. You need to understand the way you're being measured and how you want to set those expectations. And so I think that's kind of the way I think about it is, I think being a successful founder and CEO is probably necessary, but not sufficient for being a good public company CEO.
So I have a couple of questions for you. So one, you talked about Elon Musk and a little bit about Apple. I have another one about Amazon. So how do you explain that a company that was essentially unprofitable for a decade kept Wall Street happy? What was the magic there?
Yeah, so I think anytime somebody wants to say, well, wait, they can use Amazon as the example. So just the quick fun facts about Amazon. They went public in 1997 at a $400 million valuation. We had them back in last fall to celebrate their 20-year listing anniversary at a $400 billion valuation. So 1,000% growth on a $400 million. That's pretty good. So like I said, performance solves all things. I do think, they've been really clear with Wall Street. Do not expect us to yield any cash. We're not going to generate earnings. We're going to invest back into what we consider growth.
So they set KPIs that they kind of kept hammering on saying those are our KPIs and we're hitting them until...
And I wouldn't even say it's KPIs because they're saying we're going to take our cash and invest it in what we think are the best growth opportunities. Mm-hmm. When they went public, their KPI was how many books are they selling. You can't predict AWS from that, which, by the way, is already a massive public company on its own. Forget about their whole space net, right? So I think they are the exception and an amazing one. And I think it's just very hard as you look at the rest of the companies. It's a very tough challenge. I think there's a lot of great thinking that goes on in Amazon that you can look to replicate. I think our CEO talks a lot about, it's always day one, right? We want to have that mindset that we're always there kind of thinking, what's best for our customers. But I think it gets really challenging when you're trying to draw a lot of parallels between Amazon and most companies.
So I have one other question. This time it's kind of going from the giant to the really small. Like, how early can you IPO? And in particular, if to maintain your stock, you need to have analysts covering it, and they're not interested in small caps. How do you manage that?
Yeah, it's a big challenge. It's going to get a lot worse. I'm excited to tell you. So in Europe, they recently rolled out some new regulations called MiFID II. And what it basically says is financial service firms have to unbundle the services that they provide to investors. So you can no longer provide your research to the investors free of charge and then have them trade through, which is the way it's been done for years.
Sounds reasonable.
Yeah.
To unbundle. I mean,
it's not working out so well for the cable industry, so maybe good for consumers. Maybe. But so we host the largest U.S. equities conference in London twice a year. So we just got back. We were there in June last week. And the number of investors attending the conference was down 20% versus last year because they now have to pay the investment bank that we co-sponsor with to attend that conference. So what is the long-term trend for that? So then you kind of go down and say, okay, well, investors won't go to as many conferences. What's the big deal? There's probably too many conferences already. Well, if the investment banks are making less money, they're going to fire staff. The smaller ones maybe can get by because they have low cost of rent. The middle ones are really going to get squeezed, and a lot of those are going to go out of business. So then you're going to end up with fewer investment banks, with fewer analysts, covering fewer stocks. They're probably going to cover the big ones, not the little ones. In fact, a hedge fund in the UK recently came out and said, small cap stocks, you guys should start paying analysts to cover you. That's a weird incentive. If I'm paying an analyst to write research on my company, they're probably not very objective. And it's the hedge fund that's asking the companies to do so. You get into these kind of perverse incentive structures. I'm not saying there's anything perfect about the bundling of services by the investment banks, but I do think it's a classic example of the law of unintended consequences. It's also an example of how global the financial markets are. Goldman, Morgan, and JPM are not going to roll out a pricing model for their clients in Europe and not replicate that here in the US, right? So they're not going to say, oh, well, you're an investor in, Frankfurt, so we're going to charge you this way. We're going to charge the investor in New York this way. They're going to just take one approach. But by the way, all the investors are global as well. So it's going to be a global. Yes, and that is not going to be, I think there will be some interesting platforms that come out that help with corporate access. There's already a couple startups that are in that space kind of to companies more efficiently than the banks can with fewer conflicts. The question of research coverage is really going to be the big one. A lot of the companies here in the Valley, the large ones, they haven't seen the reduction in coverage yet, but I think they're all kind of thinking about what it will look like if they do start to see that reduction in coverage, which, by the way, needs to get already.
Okay, so I'll take two very quick questions to wrap it up. Yes?
So this morning, one of the presenters mentioned listening to the earnings call as a methodology for understanding the motivations of the corporate buyer. I'm wondering if these analysts would be a mechanism to maybe indirectly influence which corporate buyers to pay attention to as a potential acquisition.
So do the analysts, can they influence acquisition of companies due to the coverage?
Yeah, I mean, there's nothing that stops analysts from writing research on private companies. Happens rarely, because it's not what their customers are kind of asking for. But I think that gets to the point of forming that relationship with the analyst early. Again, as long as you're not oversharing and sharing something that maybe you don't want the corporate acquirers to know about, it could be an interesting avenue. One of the things we always advise our clients on is we provide a investor relations database where they can actually go look at their competitors' conference calls transcripts. So they can go through, not only see what questions they got asked, but then they can trace across and see what kind of questions does this analyst ask? How did they think about the world? So there's a lot of data out there on both the company side as well as the analyst side that you can use to kind of triangulate the way folks are thinking about the market opportunity.
Okay, there was one question around here, I think. Yes?
I was just curious, when do you think about Nasdaq listing and what is
So what about Spotify's direct listing?
Absolutely. So the Spotify direct listing was a really interesting transaction. So I'll give a very brief overview so everybody kind of understands what exactly happened. In a traditional IPO, the company's going to go raise capital. So they hire an investment bank called an underwriter to sell a certain number of shares to the investors. That happens the night before the stock opens. And then the next day, they run an auction to set the opening price, and the stock starts to trade freely. Right? So the benefit is you raise money, you have an investment bank out there telling your story, and a lot of investors know who you are. Spotify did not need money. Their CFO did not want the investment bank out there telling the story. He wanted to do it. And they figured most people know what Spotify is. So kind of the three primary benefits of an IPO didn't suit them. So what did they do? They just did away with that whole roadshow. They did away with the underwriters. They still hired Morgan Stanley as an advisor, but that's technicality. And they held a live broadcast teach-in for both investors and analysts, where they didn't do a roadshow. Everybody just had to kind of, dial in and kind of listen to the telecast or watch the webcast. And so then what happened the day that their stock opened? Typically, when you're opening the stock, you're only opening it with the shares that aren't locked up. Right? We talked about that 180-day lockup. Spotify didn't have a lockup. Any investor, any shareholder of Spotify could sell into the open or buy in the open. Any investor out there could buy as well. And so they were comfortable enough with their metrics and their valuation that they said the stock's going to trade between $150 and $170 a share. And opened up at 165, got up to 170, and settled about 150 by the end of the day. They also had a unique structure in that they had music labels all owned a lot of stock. Well, so, the banks could have taken that and done private placements to try to get them out of the stock, but by doing it this way, where there's no lockup, they could basically just sell into the open market and move a lot more stock faster. And the investors, which typically get cut back in IPOs, could buy a lot more stock faster. So I think overall, the transaction went really well and accomplished a lot of their goals. Now, what I recommended for other companies, I'll say, sure, if you don't need money, if you have a CFO that knows everybody on Wall Street, and if everybody in the world knows who your company is, go for it. If you don't take those three boxes, maybe the traditional IPO route's a better path.
Do you know how much they saved from that work with investment bank, or how much that cost?
The only stat I heard was I think that they paid Goldman and Morgan together something like $40 million. Investment banks for typical deals will charge 6 to 7%. For the biggest deals, those fees can come down to like 2 to 3. So then it's a question of how much would they have raised, which would kind of But for a company of Spotify size, I would say that fee savings were probably not the primary motivator. I think they were looking at other criteria.
Is there a possibility, kind of another scenario, that actually maybe investment banks or merchant banks and pension funds wouldn't have been so interested in buying their stock? So they actually went straight to direct listing to avoid pushback because it's not a profitable company yet, right?
Yeah, I think if you're going to be an investor in the music industry or research analyst covering it, you probably need to allocate some of your portfolio to Spotify, and you probably need to cover the stock. Right, they're a big, influential company in the space, and so I think
So there was demand.
there was a lot of demand. Yeah. So I think it's just they're kind of a category-defining company. So I think versus if you take a SaaS company doing $100 million a year that operates in some opaque corner of the sector. Does the software analyst need to cover that company? Does the software hedge fund or mutual fund need to own that company? Maybe not, right? But if you're covering music, you probably need to research and cover Spotify.
So now you know a new option, direct listing. So we didn't have time to cover all the exotic things like security buyouts or reverse mergers, ICOs. You guys look at ICOs a little bit.
We like
mostly blockchain stuff.
Yeah.
Never know.
So we invest a lot in blockchain internally. So we use a lot of it for a number of different use cases. In terms of crypto, we have not yet made a move into that. I think it's something that's definitely high on our radar. We're waiting for the regulators to get the space a little bit better defined. I think that one of our primary functions in exchange is not just capital formation, but also investor protection. And I don't think anybody will disagree with the fact that some number of the ICOs are not on the up and up.
So let's maybe do a quick survey. So who's considering a Nasdaq IPO now that everything you need to know about it? Raise your hand, Nasdaq IPO.
How many people want to stay away?
All right. Well, let's see in 6 months. Let's see in a year
or 10 years.
So thank you very much. And, all right, we're going to take 5 minutes to the next session. So feel free to take a break. Are you